All right, let's talk about one of the biggest questions you'll ever face as an investor. Should you be putting your money into individual stocks, or is the smarter play to stick with those exchange-traded funds, ETFs? It really feels like a choice between chasing those potentially huge returns and playing it safe with the market. So let's get into it.
So here's how we're going to break this all down. We're going to walk through 6 key areas. We'll start with the classic dilemma. We'll look at why ETFs are so popular. Then we're going to bust a few myths about diversification. After that, we'll reframe how to think about stocks, look at the tools active investors use, and finally, we'll land on what the real choice is all about.
Okay, so first up, let's just frame the problem. The conventional wisdom you hear from just about everyone seems to put these two things on completely opposite sides of the investing world.
And this slide, this just says it all, right? You've heard this a million times. ETFs are pitched as the safe, simple, set it and forget it choice. It's the diversified bet. And individual stocks, well, that's painted as a pure gamble, a high-stakes game for Wall Street pros or, people who just get lucky. But is it really that black and white?
So let's zoom in on ETFs for a minute. Let's really try to understand why they have become so unbelievably popular and what's behind this whole idea of passive investing. The appeal is obvious, right? It's all about simplicity. You buy one thing, like the SPY, which tracks the S&P 500, and bam, you instantly own a little piece of 500 of America's biggest companies. It's cheap, it feels diversified, and the promise is you can just buy it, walk away, and let the market do all the heavy lifting for you.
But here's the catch with that whole set it and forget it thing. This quote from our source material really hits the nail on the head. When you just buy the entire market and take your hands off the wheel, what is your strategy really? It boils down to one word: hope. You're just hoping it all works out in the end.
And that leads us right into this idea of the diversification myth. Because relying on hope and this idea of automatic safety, well, that can be a much riskier strategy than you think. And here's why. Think about this for a second. The source material calls this the decade of nothing for a reason. After the dot-com bubble burst back in 2000, the Nasdaq didn't see those highs again for 15 years. And the S&P 500? It went basically nowhere for 13 years, from 2000 all the way to 2013. Imagine investing for over a decade just to get back to where you started. That's what hoping can look like. So, let's get real about what kind of risk you're actually dealing with. There are basically two kinds. There's non-systemic risk, which is when one company, like Enron, just completely blows up. And then there's systemic risk, which is when the entire system has a meltdown, like the 2008 financial crash. And this is the absolute key takeaway right here. A big, broad market ETF does a great job of protecting you from that first kind of risk. If one company in the S&P 500 goes bankrupt, you'll barely feel it. But it does absolutely nothing to protect you from systemic risk. When the whole market goes down, your so-called diversified portfolio is going right down with it. You're chained to its fate. All right, so now let's flip the script and talk about individual stocks. But we need to look at them through a completely different lens. Not as a gamble, but as a path to taking control. So according to the sources, what are most people really doing when they buy a stock? They're investing for capital gains. They're buying it for one reason and one reason only. They hope the price will go up so they can sell it for more later. This approach, which is based purely on predicting the future price, is what the source material just flat out calls gambling. But there is a totally different way to look at it. You can invest for cash flow. The best analogy is owning a rental property. When you own a rental, are you waking up every day obsessing over its Zillow estimate? Probably not. You're focused on making sure that rent check hits your bank account every single month. It's a mindset shift from being a speculator to being a business owner. And look, this isn't about getting lucky. It's about having a real process. The source material lays out these 4 pillars. You do your homework on the company's health, that's fundamental analysis. You study the stock's price patterns, that's technical analysis. You build a specific strategy to generate income from it, that's your cash flow plan. And you always have an exit plan. If you're wrong, that's risk management. It's a skill you learn, not a bet you make.
So how in the world do you actually do that? How do you create cash flow? Well, this is where we need to open up the active investor's toolbox, because it's filled with things that go way beyond just buy and hold.
Okay, first, the basics. We all know this. You buy a stock, you own a tiny piece of that company. You have equity. Simple enough. An option, though? That's a completely different animal. You're not buying ownership, you're buying a contract. And what that contract gives you is a choice.
It's the right, but not the requirement, to buy or sell a stock at a price you choose by a date you choose. It's a tool for strategy and control.
And this is where it gets really cool. This is how you can use these tools to create that rent. An investor who owns, say, 100 shares of a stock can use an option strategy called a covered call. They're essentially getting paid cash right now for giving someone else the choice to buy their shares at a higher price in the future. That cash premium they collect, that's the rent check. That's your monthly income.
So, after all that, you start to see that the whole debate was framed wrong from the start. It was never really about stocks versus ETFs. The real choice, the one that actually matters, is between two mindsets: passive hope and active control.
And this table just lays it out perfectly. On one side, you've got the passive investor. Their tool of choice, an S&P 500 ETF. Their strategy? Buy and hope. Hold. Their biggest risk? A total market crash. Their whole mindset is based on hope. Now look at the active investor. Their tool could be a stock, sure, but it could also be an ETF. But their strategy is to generate cash flow. Their risk is managed position by position. And their mindset? It's all about control. And if you're not convinced, check this out. This is maybe the most powerful point of the whole thing. The source material shows how an investor, using the exact same tool as the passive investor, the SPY, the S&P 500 ETF, was able to generate thousands of dollars a month in income even while the market was going down. It proves, without a doubt, that it's not the tool that matters, it's how you use it.
So at the end of the day, it all comes down to this one simple question for you. It's not stocks or ETFs. The real question is this: are you content to just be a passenger on this crazy ride, hoping the market eventually gets you to your destination? Or do you want to learn the skills to get in the driver's seat, take the wheel, and actively build the financial future you want? That is the real choice.